Good afternoon, everyone. Thank you very much for joining us today and making the time to talk to us. So this webinar is a preamble essentially to the autumn budget. There's a lot of talk of it in the media. There's a lot of speculation around it. There's quite a lot of hype around it. There always is, but especially around this one. So we wanted to put this in place as a precursor to that. And this will be followed up by a post-budget webinar once we've all got clarity as to what's going on. But I'm joined today by my colleagues Phil and Chris, and between us, we're just going to talk you through some of the key things that are worth thinking about in the lead up to the budget. So Phil, do you want to kick us off?
Yeah, absolutely. As Alistair says, welcome to our pre-budget webinar. I can see quite a few familiar names in the audience, which is always great. But for anyone that doesn't know me, I'm Phil Bryant and I head up the financial planning team here at Acuity. And as Alistair says, joined today by Alistair, who's one of our senior client managers, and Chris Larby, one of our pension specialist advisors. And we're really looking forward to just sharing some insights with you and answering any questions that you might have. Before we begin, just a very quick note, the session is intended to be for informational and educational purposes and is not tailored advice. So nothing that we say here replaces a full personal review, but our aim today is to help you see the risks, the opportunities, and how to be better prepared for whatever may come in November. So what's the overall outlook for this year's budget? What rumours are out there? Probably best by looking at a few of the possible lowlights. Income tax, national insurance switch, so a two-piece switch from NI to income tax. Cuts to pension relief, reintroduction of a lifetime allowance, steep cuts in ISAs, cash ISA allowances, sharper restrictions on CGT, reduced annual exemption, new wealth or property taxes, annual property charges, freezing or reducing allowances, thresholds and reliefs, and treatment of rental income and national insurance on landlords. And probably the most topical is aggressive IHT reforms and potentially gifting rules tightened. So why is this the case? I think you'll all probably be aware the government is under real pressure. Public finances are stretched, borrowing costs are high, and economic growth just isn't keeping pace with expectations. The Chancellor faces a tricky balancing act, raising revenue, maintaining fiscal credibility, and staying within manifesto commitments. That probably makes large headline-grabbing increases to income tax, VAT, or national insurance less likely, though we should still be mindful of the risk of reversing any past promises. So what's probably more likely are subtler measures, so freezing of thresholds, which pushes more people into higher tax bands, tightening or removing reliefs, or introducing new levies on wealth, property or investment. So put simply, government is trying to raise money without making it obvious that taxes are going up, and the impact often comes down to the details. So even small changes can have a really significant effect. And we need to look no further than recent increase in employer national insurance and the ripple effect it had across businesses of all sizes, or how such costs can be fed into inflation for consumers. So the takeaway, don't overlook the smaller tweaks. It's essential to model your exposure and identify areas of your structure that could be vulnerable if allowances, thresholds or reliefs change. So that said, there is a slight silver lining. Current polling suggests reform are providing credible opposition, while Labour currently trails. This may force the Chancellor to tread carefully with tax increases. So overly aggressive rises could prove politically unpalatable. In other words, politics may slightly outweigh pure economics in shaping the November budget. So with that context, I'll now hand back over to Alistair, who will take a closer look at the areas of tax most likely to be affected.
Thank you, Phil. So as Phil says, let's look in a bit more depth at the taxes in the spotlight. So as a reminder at this stage, we're not aiming to speculate, merely to consider what might change and emphasize the need to not panic, nor to undertake any transactions without prior planning and that aren't carefully thought through. There are broadly five main tax areas where we're seeing the most traffic, both in the media and among other professional advisors. Firstly, of course, we've got inheritance tax, an inherently unpopular tax that has already sparked a lot of debate with changes introduced to business relief and agricultural property relief recently. And both those things could now be under the microscope once again, alongside some other reforms. There's been talk of introducing a lifetime cap on gifts falling outside the 7-year rule and or extending that 7-year rule, meaning that gifted assets could remain in your estate either indefinitely or at least for a lot longer before becoming exempt. We might see the nil rate band frozen or even reduced. That's currently 325,000 and has been for a long time. It hasn't risen with inflation. And we could see the interaction of that with the residence nil rate band also reviewed. There is further talk of tightening business property relief and agricultural property relief again. That might not be necessary if other changes are implemented. As I said, these reliefs have already been capped, currently at 1 million over 7 years and 50% relief thereafter. And trusts and more complex estate structures are going to certainly be under greater scrutiny. At the moment, property settled into trust that attracts either business relief or agricultural property relief has a £1 million combined cap with 50% relief above that, and there are no entry or exit charges before April 2026. So that means there's still a window to do some planning with trusts before future restrictions do come in, provided anything doesn't change in the budget. Assets put into trusts not attracting those reliefs will still continue to attract the same entry, periodic and exit charges. So planning around trusts will certainly still carry overall effective tax reductions on estates in terms of getting assets out of your estate and subjecting them to lower charges. But all the other reasons for using trusts will still remain, of course, namely asset protection. Capital gains tax is another one to watch. We've probably all seen the possible headline changes here. There's talk of aligning CGT rates more closely with income tax, which will, of course, significantly raise the overall tax burden on asset disposals. The annual exemption may be reduced further. There's always speculation every year, not least this year, around limiting or scrapping entirely business asset disposal relief, which currently offers 100% CGT relief on disposals of business assets and trading company shares up to the first 1 million of gains. But it's an inherently unpopular tax generally. And other potential changes include applying CGT to very high value main residences, or tightening the rules around second homes, and potentially looking at holdover and rollover reliefs, which are vital tools for anyone pursuing succession planning or business restructuring, and something that we see a lot with our clients. So again, these are areas where entrepreneurs, investors, property owners could feel a real tangible impact. With property specifically and property taxes, there's been discussion about moving away from stamp duty and instead introducing some sort of annual property levy. We might see council tax bans for higher value homes introduced, or new ones introduced, and potentially bringing rental income into the national insurance system, which will not be popular for a lot of, certainly our client base, of course. There's also talk of additional charges or CGT for homes sold above certain thresholds. So for landlords and property investors, the key theme here is likely to be greater ongoing taxation rather than one-off transactional charges necessarily. And on the business side, with business taxes, we could be looking at reducing business rates relief, lowering the VAT registration threshold, which would draw a lot more small businesses into the VAT net, potentially tightening eligibility for capital allowances, and potentially even further changes to R&D tax relief. The focus here seems to be on broadening the tax base and ensuring reliefs are targeted only where they're actually driving genuine investment in the economy. In terms of allowances and what we call fiscal drag, there are some broader themes here. We're likely to see a continuation of frozen income tax thresholds, which is what we mean by fiscal drag. That means that as everyone's earnings rise, more people gradually move into higher tax bands, and it's a stealth tax effectively. There has been talk as well more recently of national insurance applying to partnership profits. So that would be something for doctors, dentists, lawyers, and indeed accountants, particularly to think about, and also some speculation around ISA limits and changes to that, and discussion of a possible exit or wealth levy for individuals leaving the UK. Nothing confirmed, but the main point seems to be the government's looking to raise revenue subtly, as Phil indicated, without headline rate increases. So I'll hand over to Chris now to talk about pensions in a bit more detail.
Brilliant. Thanks for that, Alistair. So I hope you'll forgive me for having a case of deja vu. I don't think a year's gone by without having to answer questions about tax-free cash in particular. Yeah, the speculation is right about changes to pensions legislation. So we're going to run through the main rumours, get our take on them. But I'll start with tax-free cash because I think that's the main one. So rumours that tax-free cash is going to be removed, reduced, or restricted. That's nothing new. But yeah, currently people can take 25% from their pension. It's capped at 268,000, just over 268,000 for in line with the lump sum allowance. But I think there's plenty of reasons to be doubtful about the rumours. So I think governments are going to be well aware problems of the mass sell down financial markets. So not just DC, but DB pensions as well. So these are sort of institutionally invested pension schemes with much less liquidity. It'd certainly be problematic if there was a sort of run to everyone to draw their lump sum. It'd be incredibly unpopular. So I think the government already lacks the political breathing space for such move, but we'll see. And I mean, there's already lots of changes to pensions recently. So scrapping of the lifetime allowance in 23, scrapping the charges in 23, removing it altogether last year. Pensions falling within the estate from 2027. So I think the government's going to be very mindful of sort of further upheaval that further changes are going to make. So I mean, I've always said to clients that tax-free cash has been a sort of mainstay of pension framework, certainly for as long as I can remember. People make their plans around it and rely on it for their retirement, paying off the mortgages. And things like pension mortgages still exist. So I think we always got to be careful about these rumours, particularly that one around changes of tax-free cash, or major changes, shall we say. And I think there's reasons not to be too hasty as well, make any rash decisions. So yeah, potential changes that are made, we feel are likely to require royal assent, which should mean there's some time to act on any changes that are going to affect you. I mean, let's not forget that monies grow free of all taxes inside the pension. So unless you've got a specific use for that, taking that money out just for the sake of it, it's probably going to be less efficient. And of course, someone pointed out the other day, a future government could easily unwind the changes. We've taken all that money out. It might be a big decision that you regret in hindsight. I would say though, and I've said this to people recently, if you're planning on, you've got something pre-planned to use your lump sum for, specifically, something in particular for the next year or so, yes, you could consider taking it out now if you're particularly worried about how that might affect your plans. But yeah, just be mindful of those other implications I've mentioned. So we'll move on to the next one. So capping or removing high rate relief on pension contributions. So I mean, tax relief and tax-free growth are the main incentives for people to save into the pension, not least obviously to have enough money to retire on. Additional higher and basic rate taxpayers have to pay 55p, 60p and 80p to invest £1 to the pension respectively. And in retirement, most pensioners pay less than that. And so the rumours that the biggest rumour we sort of seen is a shift to a flat rate, possibly 30% has been mooted. I think there are reasons to be mindful about this. If there are changes to pension legislation, should we say, pension tax relief is a lower hanging fruit, I think, than changes to tax-free cash. Treasury, I mean, they spend 50 billion on relief, and 2/3 of which goes to high rate taxpayers. And I don't think it would be as unpopular as tax-free cash changes, for instance, also to be fully appreciated by the masses. But I mean, there are reasons to be doubtful though. So, it's quite complex. It's kind of built into most providers, payroll providers, HMRC system, pension systems. It'd be really radical change to sort of bring about that change quite quickly. So quite a difficult one. And of course, I mean, we hear every day we've got an aging population. The government needs to incentivise pension savings. So yeah, we'll see. But it's a low hanging fruit certainly. But yeah, we just need to be mindful of that as well. I would say from a planning perspective, you've got plans to make regular plans, well thought out plans to make pension contributions. It might not be a bad thing to bring them forward if it's feasible. It just alleviates any concerns that you might have. So, moving on. Number 3, reintroduction of the lifetime allowance charges. So previously you'd pay 55% on a lump sum or 25% on income in excess of the lifetime allowance. If you remember, the Conservative removed those charges in April 23, introduced the lump sum death benefits allowance a year later, and then Labour last year reacted to bring pensions into the estate for IHT to kind of counter some of those measures, and that's from 2027. So I think whilst there are reasons to be mindful, certainly it's clear that the current government sees pensions for retirement purposes rather than sort of vehicles to transfer wealth to the next generation. I think there are more reasons to be doubtful. The prospect of IHT now on pensions on second death, plus the potential for income tax on second death after age 75, I think they already disincentivise using pensions for transferring wealth. So I think introducing further charges or changes would be unnecessary, but obviously incredibly unpopular. So just a quick one, some other potential changes that we're hearing about, or hearing rumours about, I should say. National insurance. So currently employer contributions and employees that sacrifice salary for higher employer contributions, they're both exempt from NIC or national insurance contributions. So there's rumours the Chancellor could reduce or remove that benefit. I guess it's a potentially subtler way of reducing pension tax relief than changing the sort of headline rates. So that's certainly one that we're keeping an eye on. Changes to the annual allowance. It's currently 60,000, tapers for high earners above 260k a year. I guess it could be reduced, start the tapering earlier, or change the way carry forward works, which is the ability to bring forward or go back to sort of previous 3 years allowances that haven't been utilised. So I guess there's a number of measures that they could make that would probably be less headline grabbing than the sort of changes to tax-free cash and pension tax relief. But in conclusion, I mean, the rumours certainly point to narrowing the tax advantage for higher earners. Certainly the majority of Labour voters, I guess, would be less sympathetic to. Reducing the cost to the Treasury in the long term as well. Obviously key themes of that. But for now, I mean, our message to clients is avoid making rash and unplanned decisions, certainly based on speculation. Consider the full impact of any changes that you might make, short term and long term. Take advantage of any windows of opportunity before and after the budget, of course. Certainly if you've got stuff planned. But yeah, importantly, engage with an advisor. Make sure they look at things holistically rather than focus on sort of one area in particular. But yeah, I hope that's pensions covered off adequately. I'll pass you back to Alistair.
Thanks, Chris. So taking things back to a business ownership context, the prevailing advice at this stage is, again, don't do anything drastic. No structural changes ought to be required in advance of the budget unless they were already otherwise planned. There will most likely be time to undertake any necessary restructuring or pursue any new tax planning solutions prior to April next year, once we have knowledge of the final budget. As many of you know, personal and corporate tax issues often overlap. How you take profits out of your business, how you structure ownership, when you choose to sell or reinvest, all of these areas are closely linked. If we think about profit extraction, first of all, with possible changes to income tax or dividend rates, it's sensible to look at the mix between salary and dividends, the quantum of contributions by the company to your personal pension, and the timing of any bonuses. Critical balance is ensuring corp tax deductibility and the optimal mixture of deductible above the line remuneration with post-tax dividends. No need to make changes straight away, but having a plan means you can act quickly and efficiently once the budget announcements are confirmed. But this is something that should have been getting done annually anyway as part of a review. In terms of business structure, if you're trading as a sole trader or a partnership, it might be worth considering whether a limited company could provide more flexibility. That could be the case regardless of the budget. Or if you're already incorporated, perhaps using a holding company or a group structure could offer protection and planning opportunities, particularly if CGT and IHT rules change. And indeed, the insertion of an investment company into your structure might become more appealing as a result of the flexibility to start reinvesting your trading profits without any personal tax leakage. This is an area where we can easily model different scenarios for you. We can see how each structure might affect your future tax position. Each individual and business is different, but applying these common themes, an optimal structure for you can be identified. And even if that's what you've already got in place, at least you'll have the comfort of knowing that. In terms of disposals, for anyone thinking of selling shares or business assets, timing could be quite key. If the government does move to increase CGT rates or restrict reliefs, there could be an advantage in completing a transaction before the new rules take effect, if already planned. We already know that business asset disposal relief will be rising again to 18% in April next year. So anyone considering selling their business or shares in their trading company and or any other business assets could be well advised to assess if that can be completed prior to April. But just to reiterate, rushing to sell purely to beat the budget is inherently risky, commercially and tax-wise. The best approach will always be to come and speak to us, get valuations, review your options, and be ready to move once we've got some clarity. Regarding reliefs and incentives, as we said before, capital allowances, R&D, other investment incentives, all under review. They could be tightened, they could be refocused. Making sure you're claiming everything that you're entitled to as a business under the current system is important, even if it's just ensuring that assets are added to your capital allowances pool. That it's pretty critical to just make sure that's happening. And finally, we should just all keep an eye on business rates and VAT, whether that's a reduction of rates relief, a lowering of the VAT registration threshold, pulling more businesses into the VAT regime, modelling the impact of that and the potential changes now to understand the impact on cash flow and margins is certainly advisable. The main takeaway therefore is review now and act later for business owners. Take the time to check your structures, the reliefs available, and any upcoming transactions while the rules are still clear, but avoid knee-jerk reactions. Once we've got the actual detail of the budget, you'll be in a strong position then to make calm and informed decisions rather than rushed ones. And Phil is now going to shine the spotlight more on high net worth individuals and families.
Thanks, Alistair. So let's turn to what all of this could mean for wealthier individuals and families, people who have built up property portfolios, investment holdings, or business assets. So for this group, the upcoming budget isn't just about reacting to change. It's really about using the time between now and November to make sure everything you've built is structured properly and protected, whether those changes actually come or not. So looking at inheritance, gifting and trusts. So as we've mentioned already, one of the biggest talking points right now is inheritance tax. It's always politically charged, and it's one of those areas that can be changed quite easily by adjusting thresholds or exemptions. At the moment, we still have 325,000 nil rate band and 175,000 residential nil rate band. So a couple can potentially pass on up to £1 million tax free if everything is structured correctly. But there is growing speculation that the government might look to freeze or even scale back some of those allowances. So what should we do now? Well, first, make use of the simple stuff, the annual gift allowance, small gifts and gifts out of normal income. Those are easy wins and people often overlook them. If you were planning larger lifetime gifts or trust settlements, it might well be worth getting those done now rather than later. Again, not out of panic, but simply because the current rules are generous and clear. One thing that is often forgotten is liquidity and making sure that your estate actually has cash available to pay any future inheritance tax bill. And that's where life insurance written into trust can be really powerful. It creates tax-free liquidity exactly when it's needed. Pensions and tax relief. I'm not going to dwell too long on this, as Chris has done a good job of explaining the implications. But pensions remain highly tax efficient. Rumoured changes like flat 30% tax relief will benefit basic rate taxpayers and simplify the system. Don't rush to make decisions. Any major changes, potentially tax-free cash, would likely need royal assent. So there is potentially time to adjust and pivot depending on what comes out in November. Also ensuring that you're maximising your annual and carry forward allowances and reviewing beneficiary nominations, since from 2027 pensions will form part of the taxable estate. Investments and savings. On the investment side, there's a lot of rumours that point towards tightening the reliefs, specifically those available to higher earners. If you're investing personally, simple things, making sure that you're fully using your ISA and pension allowances. They're still the best wrappers for long-term tax-efficient growth. And for more experienced investors, VCT and EIS can still be very valuable tools, particularly for higher earners facing larger income tax bills. VCTs remain attractive because of their 30% upfront tax relief and tax-free dividends, while EIS investments, often regarded as higher risk and more volatile, can still play a role for those comfortable with longer term illiquid investments. Worth noting, some of the inheritance tax advantages linked to EIS were reduced in last year's budget, so they're now more of a tax efficient growth tool than a core estate planning one. And I think this is quite a key point. With pensions set to become part of the taxable estate from 2027, business relief investments, previously known as business property relief, they're starting to be featuring more prominently in our estate planning conversation. And when they're used appropriately, they can remove qualifying assets from the estate after just 2 years, and each individual currently has a £1 million allowance. That said, as with any investment, suitability and risk are key. It isn't a one-size-fits-all solution. The good news is that there are now BR qualifying options designed to deliver steady, low volatility returns. So it doesn't always mean taking on higher risk to achieve that inheritance tax efficiency. Property and valuations. Property is another very big area where wealthier families could see change. And I work a lot within the property sector for Acuity, and I've got a significant amount of portfolio landlord clients. It's easy to raise money quietly through property-based taxes. Things like new council tax bans, annual property charges, or tightening rules on buy-to-let reliefs. So if you haven't had your portfolio revalued recently, it's worth doing so, not just for tax reasons, but to be ready if the government does decide to introduce value-based levies. Section 24, again, it's an issue that's close to my heart and certainly close to my clients' hearts. That's already shifted the goalpost for landlords, and that's driven many portfolio owners to incorporate using Section 162 incorporation relief. That route remains fully legitimate and compliant when applied correctly, and we don't expect that to change. But after last year's tightening of the insolvency practitioner incorporation route, and with HMRC paying closer attention to certain promoters, in particular less tax for landlords as one, I'd say if incorporation is on your radar, it's now probably time to pursue that further under the current rules with the certainty that we're currently enjoying. For developers or mixed-use property owners, keep an eye on stamp duty and business asset disposal relief. Both are relatively easy levers for the Chancellor to pull if more revenue is needed. And finally, liquidity. This is one area that catches a lot of families out. We often see people who are asset rich but cash poor, and that becomes a real problem if there's a sudden tax bill or a change in the rates. If you've got substantial assets tied up in property and business, think about your borrowing capacity now. It's far easier to refinance or release capital while you're under no immediate pressure to do so. Some families are using family investment companies to hold assets and generate income more flexibly, and that can also make it easier to manage cash flow for tax events. So the goal here isn't to sell or restructure everything, it's just to make sure you're in a position to move quickly if you need to, with flexibility being the key. So for high net worth families, the message is don't panic, but don't stand still either. The current rules are still attractive, better than many people realise, but we're in a period where the window to take advantage of them could start to narrow. It's about having your paperwork up to date, knowing your exposure and having options ready. And that way, whatever happens in November, you're not reacting, you're already prepared. Alistair, I'll pass over to you just to look at what common mistakes can be avoided before the budget.
Thanks, Phil. So what are these mistakes that we all want to avoid? Why should we all be sitting on our hands in the over the next few weeks? Well, the first mistake we want to avoid is just reacting too quickly to speculation. Every time there's a budget or a major fiscal event coming around, the headlines are full of rumours. Many of them never materialise, or at least are never as bad as they're made out to be. We've seen clients in the past sell assets or transfer shares purely because of something they've read in the papers, only to find that the change didn't happen or wasn't as severe as first feared, and then they're stuck because these things aren't reversible. So by all means prepare, but don't act on rumour alone. We also don't want to be over planning for worst case scenarios. Not every floated change will make it into the budget. Often things will be phased in with transitional reliefs, or at least phased introductions. If you overreact now, you're locking yourself into a structure that could be less efficient when the dust settles. I have seen questions come in about the extent to which certain things, such as the abolition of the 7-year rule on gifts for IHT, the extent to which that could be applied retrospectively. You can never say never, but generally history has taught us that these things often things aren't applied retrospectively. If we think about the changes in 2024 to agricultural property relief and business relief, the introduction of that £1 per person limit that we were talking about earlier, that was introduced on or the day after budget day. It wasn't applied retrospectively. The VAT on private school fees was also not introduced retrospectively. There were anti-forestalling rules put in place because it was getting silly, some of the transactions that were being entered into in the lead up to that, but again, not applied retrospectively. Even as far back as 2006, when Gordon Brown overhauled how accumulation and maintenance trusts and interest in possession trusts were taxed. Again, that applied to trusts created after budget day. So never say never, but it's not worth panicking about stuff being applied retrospectively when generally that's not the case. We don't want to overcommit in terms of liquidity. We don't want to find ourselves, therefore, as a result of panicking about the cap on gifts or the abolition of the 7-year rule. We don't want to find ourselves gifting or investing large sums to preempt such a rule change, and then finding actually you've got no flexibility to liquidate that investment or get the cash back. You've got to keep a cash buffer, as Phil was saying, to manage not just your IHT liabilities, but all future tax bills and other business needs, and just plan for market shocks, which is also another backdrop potentially in terms of the stock market to this budget. And we don't want to ignore compliance either. Don't let planning get ahead of compliance. HMRC scrutiny is drastically increasing. We're seeing it across the board. If you are going to make significant changes, make sure everything's documented. Make sure the reasoning and commercial rationale are clear so that the planning stands up to any professional review. The key takeaway, therefore, is if you wouldn't do whatever it is you're thinking about doing, if it weren't for the budget, don't do it ahead of it. Just wait and see. In terms of practical steps that we can do, obviously do review your current position personally and across your business and all investments, your estate planning, your ownership structures. Make sure you know where all of your assets sit and what release you're currently relying on. And that will help you to start modeling out scenarios. We can certainly help you with this, so do get in touch. But ask yourself what would happen if, say, CGT rates were to rise by 10 percentage points? What if the nil rate band stayed frozen for another couple of years? If you run through those possibilities, you can stress test your finances, both in terms of your business and personally, and you'll feel a lot more prepared as a result. If plans are already in motion in terms of transactions or reorganizations, as we've said before, perhaps you're planning to make a disposal or restructure your group or your business. It might make sense to do that. If the plans are already in place, it might make sense to do it sooner rather than later, but only if it's something that you would have done regardless of the budget. As we've said, document everything carefully. Make sure that you've got commercial rationale in place for anything that you are doing, and ensure that if HMRC were to ask you what it is you've done and why, you've got clear documentation and reasoning to give to them. And finally, just engage with advisors like us nice and early. If that's your accountant, your solicitor, your financial planner, it doesn't matter. Where there are periods of uncertainty like this, timing and structure matter more than ever. A conversation now can save a lot of cost and a lot of stress and missed opportunities further down the line. So Phil, do you want to just finish us off?
Yes. Thanks, Alistair. So this pre-budget webinar, as Alistair mentioned, is about raising awareness and prompting early planning where possible, not making final decisions at this stage, trying to cut through the noise a bit of the rumour mill, because lots of budgets have rumours, but this one seems more rife with rumours than usual. And as soon as the Chancellor delivers that autumn budget, we will then be in a position to host a post-budget analysis webinar for all participants, and then we'll be able to look at which of those rumours actually became law, the direct impact on business owners, property investors and individuals, and what next steps should be taken in the short, medium and long term. So between now and then, our advice is fairly simple. It's stay calm, stay informed and prepare sensibly. Uncertainty is never comfortable, but it does bring both risk and opportunities in certain circumstances. And as Alistair says, those who review and stress test their plans now will be best placed to respond when the real measures land. So thank you very much for attending today. Very much appreciated. I hope you found it useful. We've had some questions that we want to run through. I'll pass the first one to Chris, because there's a pension related question with regards to tax-free cash. So Chris, if you're able to just address that, that'd be great.
Yeah, thanks, Phil. So the question about tax-free cash, can you just remind me what that is? I haven't got visibility of that on the Q&A.
There's someone who's asked a question. It's quite an interesting question, and it's come up quite a lot recently. Is the cooling off period or perceived cooling off period of taking a lump sum? So if you take the tax-free cash, can you reverse that decision afterwards under a cooling off period?
Yeah, it's an interesting one. And I think our go-to answer would be check with your pension provider, because they're not going to all do the same thing. I know last year providers allowed clients to kind of cool off, so unwind the payment, make the pension sort of uncrystallize the crystallization event ultimately. But you might have got away with that last year. I think you're less likely to this year. So HMRC and indeed FCA clarified that while they see kind of cancellation rights has been quite important for new products, new payments into pensions or pension transfers, the cooling off notice, as it's called, the 30 days is there, but exercising existing options such as taking a lump sum, exercising existing option with an existing plan isn't going to basically give you the cooling off right. So don't expect those if you had them last year. I think the answer is basically echoing what we've said before, which is do things if they're planned. There's maybe no harm in bringing them forward slightly if they're planned and sensible. But making rash decisions to take the lump sum out probably isn't going to be the right thing, and I think it's unlikely, less likely than last year, that you'll be able to unwind it.
Thanks, Chris. Alistair, I think there's a couple of questions that you've identified that you'll be well placed to address.
Yep, thanks, Phil. The first question is, what are the likely threats to passing on funds to children while still alive, and how can those threats be mitigated? So as a reminder, there's currently a 7-year rule in place with taper relief applying. There is also the freedom to make gifts out of excess income, which often gets overlooked. That requires careful documentation and evidencing to HMRC that the gifts genuinely are out of excess income, and then there's no, and then there isn't the same cap. Both of these could be subject to change. There could be a cap on gifts. There could be an extension of the 7 years, or just its abolition. We don't know. As I said, it's less likely to be applied retrospectively, but you can't be certain. Whatever funds can be given away now, it's still worth considering doing that, as long as it's not a knee-jerk reaction and your ongoing liquidity has been considered. No matter how much you trust your children or whoever your beneficiaries are, given it's helpful to document any gifts actually as a gift, once whatever it is has been given away, it's not yours anymore. It's also worth noting that if we're talking about cash, there are no issues here. For assets, though, CGT needs to be considered, where those assets aren't business assets or trading company shares. For example, just giving away shares in a property investment company would trigger CGT. There are smarter alternatives and more efficient solutions available in that context than just an outright gift. So do get in touch if you're if that fits within kind of your world at the moment. Another question is around similar vein in terms of IHT. It's would there be what would happen if I were to put a child on my house mortgage, which is currently being renewed, and what does that manage to avoid any IHT, and what would the stamp duty implications of that be? So first of all, I think if we're discussing investment property, we'd need to consider CGT on any deemed disposals, as I said before. Also, if the child is under 18, any resulting income arising from that investment property would still be assessed on you as the transferor or the adult. The situation is slightly more nuanced if the property is held in a company and we're discussing shares in that company. There are more potential planning solutions available to us should that be the case, but again, documentation is key and valuations are key. SDLT wise, so stamp duty wise, whether it's an investment property or your primary residence, there shouldn't be any SDLT on the amount of any gift, but any assumed mortgage or the proportion of the mortgage assumed by whoever's name is being added to it, that would be chargeable to stamp duty. So just worth bearing that in mind because that is chargeable consideration. If we're talking about your main residence here, PPR would exempt any CGT, so there wouldn't be a deemed chargeable disposal because you're covered by your main residence relief. But stamp duty would still be in point, depending on the mortgage situation. And of course, what often gets forgotten here, where we're talking about giving away chunks of or all of our properties to children, is the rules around gifts with reservation of benefit. If you're still living in the house, HMRC are just going to contend that it is still essentially your house. You haven't really given it away. It's still part of your estate. On the flip side, your beneficiary, so your child, is going to lose out on any first-time buyer reliefs if they buy another property, because the stamp duty rules look at things differently to the Inheritance Tax Act. So you can get into quite a messy situation there, whereby actually you're doing more harm than good if you're just giving away your share of a property that you're continuing to live in, and the child receiving that property from you, or that share of the property, isn't charging you any rent for being there, isn't covering any of the bills or anything like that. So there's a lot of substantiating required to support that if that's what you're going to consider doing. I think that rounds off the questions. I don't think there are any more, Phil, that we need to address.
No, I can't see any more. But if there are any more questions, or if we find any, we will come back to you offline after the event, just to make sure everyone's questions are addressed if we haven't been able to go through them today.
There is one further question I did just quickly see, Phil, just in response, I think, to what I was saying. So if there's no mortgage and there's an outright gift of a property, then if it's your primary residence, so that there shouldn't be any SDLT because there isn't any chargeable consideration. CGT wise, it's going to depend if it's your main residence or not. If it's your main residence, then it should be exempt CGT. If it's not, then no, there is a deemed disposal there at market value. Okay. And I think that is it now, Phil. So
great, and I think we've actually finished spot on time as well. Thank you everyone for attending. We'll send the notes out and links for those that haven't been able to be here, and we look forward to seeing you with hopefully some good news after the budget in November. But any queries, questions on the back of this, please let us know, and we'll be very happy to come back to you and let you know.